Now, the funny thing I get is every day. I guarantee if I look at my mailbox shortly, I'm going to have more questions from friends and associates. Well, do you think Bitcoin's going to hit 50,000? Do you think Bitcoin's going to fall back below 40? What do you think? Should I buy it today? Should I sell it today? What should I do? Well, what will the prices be tomorrow, next week, or next year? Well, when investing or trading, be easy if we knew the answers to these questions. But I don't have a crystal ball. I don't have a Ouija board. And if you're attending this class in the hopes that technical analysis has the answers to those important questions, it doesn't. Nobody can really predict what the markets are going to be like in a few minutes, more or less a few days. But technical analysis can help us make smart trading decisions. So let's get on talking about my favorite. In fact, it's the only indicator I use because I'm a price action trader, but it's MACD. Moving average, convergence, and divergence. Now, if you keep in mind a couple things, these are called indicators. Why? Because they indicate. That's all they do. They indicate what's happening in the market. If you also remember that all indicators, no matter what they are based on mathematical formulas that can only use 5 pieces of data: the open, the high, the low, the close, and volume. That's it. There's nothing else that they can use. So they're all different mathematical or statistical calculations of those pieces of data. So if you think of indicators as the interpreters of the market, when you can't understand exactly what the speaker is saying, you can use an interpreter to maybe figure it out. Now, MACD was developed in the late 70s by Gerald Appel. And it's got a really big name. And I think that's why I first started paying attention to it, because I like the name: Moving Average Convergence Divergence Indicator. And it is today one of the most used indicators in the marketplace. But if you think back to the late 70s, again, I just gave you my background. There was no computers. Well, there were those computers that took up a whole great big air-conditioned room and that green screen, but there's definitely no internet. Okay. And the markets moved a lot slower, and the predominant market that was always traded, there was virtually no speculation in those days. The predominant market that was traded were stocks. And when Gerald Appel developed MACD, it was one of the most reputable stock indicators. Now, it's used to spot changes in strength, direction, momentum, and duration of a trend in a stock's price. But today, MACD is one of the most popular and broadly used indicators for Forex trading. The letters MACD stand for Moving Average, Convergence, and Divergence. MACD indicator, which requires moving averages as input, falls into a group called lagging indicators. Well, what we found is the market's changed, and we got online trading, and we got Java charts and HTML charts, and we got all this fast moving stuff moving in 4 digits to the right, and we got this huge growth in retail investing. We found that MACD works great in those markets, and it adjusts quickly and works in very small time frames. Now, when we say that MACD is a lagging indicator, that sounds horrible, doesn't it? It sounds negative, but it isn't. All indicators fall into 2 categories. They're either leading or lagging, but it's not like the teacher has called you from school and said your kid's leading the class and you're really proud, or the teacher tells you the kid's lagging behind in his studies and you're really upset. Nah. Most indicators are lagging because when they have to use the open, the high, the low, and the close, guess what? If you're using the close from the last price point, the last price bar, they're lagging behind the market because they need that market, that price point to close before they can do the calculations. So that makes them a lagging indicator. So they're really a verification and confirmation tool. There's very few indicators that are leading indicators. Now, if we start with just basic simple moving averages, a simple moving average is a lagging indicator. Why? Because you need the close of the last time frame to add into that calculation to predict, to put the moving average on the chart. So that means by the time you did the calculation, put it on the chart, that prior time frame is over, so it's lagging behind. Now, because traders worry about leading and lagging, we've developed EMAs, exponentially weighted moving averages, which we hope, or the idea behind an EMA was to reduce the lag time because it gave more validity to the most current close and therefore adjusted more quickly. And then we've gone one step farther than that. We moved to what we call displaced moving averages, where we take the same moving average, but we put it 2 or 3 or 4 time frames forward on our chart. And that starts to move it to a leading indicator. But because we have these different types of leading and lagging, it's important. MACD lags, but it has a very short lag. Now, the function of MACD is to discover new trends and help identify the end of current trends. There are various ways to gauge these signals generated by MACD, and many traders use their own unique settings and methods. Now, as we can see here, MACD is placed on the bottom of our chart. Now, don't worry, we're going to go over to live charts in a second. In a separate window underneath price. The moving average convergence divergence tool is a relatively easy to use indicator, but it's crucially important to understand it fully before using to attempt its signals. Now, this is a problem I find with most traders, is somebody tells them about an indicator, and because today you don't have to do anything except click a button. So somebody tells you RSI is great, and when it's over 70, it's telling you to buy, and when it's under 40, it's telling you so, whatever. They just click on the button, drop RSI on their chart, and they just wait for a number to appear. They have no idea what that number represents, how that number is calculated, and how to tell whether it's a false signal, a strong signal, how to tell if maybe that range doesn't work well for that particular asset. It is the most important thing about any indicator is to understand how it's calculated, what the lines come from, because that will help you spot good signals and will help you understand when you're getting false signals, and it'll help you interpret better how to use the indicator. Now, even though MACD is easily adjustable to your own personalized settings, MACD is based on a 12 period and a 26 period EMA, exponential moving average. And its relationship to those moving averages. Okay, so let's go over to a live chart and let's work through this. Okay, now we're looking at my teaching chart, and we're looking at the Euro US dollar 1 hour chart. Now I'm right now have on this chart a 12 period and a 26 period moving average. Now, if we were just to use these, we would be using a simple moving average crossover strategy, okay, which is kind of not a bad strategy, but works well. We're also using a simple moving average. So as you can see, this moving average couldn't be put on this chart until this bar closed right here. So it's lagging. So in order to get rid of the lag, instead of using a simple moving average, for Bollinger Bands, we use an EMA, an exponential moving average. So we click down on our charts right here, and we use a 12 period EMA, and a 26 period EMA. Okay, and again, we can see there is a slightly different response or calculation when we look at this EMA as opposed to when we were looking at the simple moving average. And it's adjusted more quickly to the price change because we've given more weight to the close of this last frame. But that's not important for Bollinger, for MACD, but it is important for you to understand. Now, if we were to simply use these, we're just using a moving average crossover strategy. But this is just the start of MACD. MACD takes then the difference between the 12-period moving average and it subtracts the value of that same time frame, the value of the 26-period moving average. So if we were to take this value here and subtract that value, we would always get a positive number. When it crosses over, like here, and the longer period moving average, I'm sorry, I've got them backwards here. The blue is our 12 period and our gold is our 26. So if we were to take here and subtract the gold, we would always have a number larger than 0 because it would be a positive number. When we take the blue line and is lower than the gold line and subtract the gold line, because we're always taking the blue line and subtracting the gold line, that would give us a negative number lower than 0. So MACD uses a 0 line, and then what it does, it calculates the difference between the two moving averages. Simple. Take the 12 period, subtract the 26 period, whatever that number is, you plot below. And this is called the MACD line. And so that line that you see on the bottom of our chart is the MACD line. And that is simply the difference between the blue and the gold. And like I said, when the blue is above, which is a 12 period, is above the 26, it's going to be above the 0 line. When it's the opposite, it's going to be below the 0 line. And that's just the first step in MACD. Now, we can describe these as the faster and the slower moving averages. Anytime you're using multiple moving averages, the moving average with the shorter period is called the faster moving average because it reacts faster to price changes because you're using a shorter look back period. So we're subtracting the fast moving average, we're subtracting the slow moving average from the fast moving average, and we're plotting it down below. Okay, but again, that blue line down below is simply the difference of the two lines above, and it would simply give us a moving average crossover strategy, because what happens every time price crosses over, doesn't matter which number and which way it crosses over, when they cross, the difference between two exact numbers is always going to be 0. So when you see that the MACD line goes above or below, crosses over the 0 line, we know the two lines above have crossed. If it crosses above 0 and rises, we know the faster moving average is becoming larger than the longer moving average. If it crosses and goes below, we know the longer moving average, the long-term moving average, is larger than the short-term moving average. So that's what the first line on our MACD chart tells us. The next way is because Bollinger just, Apple didn't want to just simply say this is an indicator. We have the next line And that's called a MACD trigger line or a signal line. Either one is usable. And that line, which is now on the bottom of the chart, is simply a 9-period moving average of the blue line above. So at this point, we no longer need the moving averages on our price chart because they're irrelevant to everybody and everything. They just make a mess. So all of that information is contained below. Now, the theory of MACD is when the blue and the gold line below, the MACD line, which is the blue line, and the trigger line, which is the gold line, cross each other, they generate buy and sell signals. So in other words, we had a crossover here. We had a crossover here. We had a crossover here and here. We had a cross here. We had a cross here. Cross here. Cross here. Cross here. Each one of these crosses is a signal. I can't draw a straight line going upward there. Is a signal to do something. Okay. It's either to buy or to sell, depending on which way the lines cross each other. If the signal line crosses the MACD line, it's a sell signal. If the MACD line crosses the signal line, it's a sell signal. A buy signal, I'm sorry. Now, let's get rid of these because my drawing lines are terrible. Okay. But this is not the beginning or the end of MACD. This is still just part of MACD. Okay. Now, a lot of people use these crossovers as buy and sell alerts, transaction signals, and they work extremely well as transaction signals. And the problem though with MACD is that MACD does not at any time take in consideration of how long that move would be. Okay. It's telling you to buy, there's a buy opportunity, but it's not telling you that the price can go up 5 pips, 9 pips, 14 pips, 22 pips. It's just right now, the asset's offering a buy opportunity. You have to, as a trader, determine whether it's going to be a strong enough buy to enter the markets. And this is why MACD can whipsaw you in and out of trades quite often. Like here, we get a buy signal. Well, price moved up here to buy, but then we get the crossover and a sell signal. And then we got another buy signal. Well, this buy signal happened to be very good, and you got a large move here. Here you got a crossover, but you really got sideways action. But it gave you, if you had entered here at this buy here, that would have been a good sell to get out of the markets at this point. But if you took it as a sell signal that the markets were going to fall, well, the markets did fall, but not enough that you could have covered your spread or made any money. Now, looking at these exact crossovers and what MACD is doing can get kind of confusing. Like I said, I even mix up buy and sell signals, buy and sell, because I don't ever look at these lines. Most people don't. Most people that use MACD. MACD goes on to the next step and creates what we call a histogram. And a histogram is a beautiful visual representation of all that we've been talking about. So this is called the histogram. The histogram is a visual indication of what these two lines are doing. So as you can see, when we got the crossover, let me get a marker on here. On a crossover here, I don't care whether the long is crossing the short or the short's crossing the long or the trigger line's crossing the MACD, because on my histogram, I know exactly what happened. They came to zero, and I got a crossover to a buy scenario because the red turned to green. Here they crossed over, and I got a sell scenario. The red turned to green. The depth of the depth of these histograms tell you whether the market's getting overbought or oversold. This is telling us the momentum in this market, but it's also telling us that the market is losing momentum as we get here. And this is how you can analyze the market and the price movement by looking at the width and the depth of the histogram and how it's changing. So a lot of traders leave the MACD and the signal line on their charts. I get rid of it all because I like my charts clean. So if you were to get rid of the MACD line and the signal line, what you're left with is a beautiful detailed histogram. That histogram is based on the zero line, and you can tell everything about price movement, everything about signals, everything about the trends by looking at that histogram. So that is how we put MACD on our charts. Now, when you go click the MACD indicator line up here, it's going to put it all on your charts for you. Now, there's all types of gurus out here. So I just dropped down a chart. It gives you it gives you everything. Then you can take off what you don't want to use. Now, the thing about MACD, it also will allow you to adjust your inputs. Okay, now there's lots of gurus in there preaching everything, telling you to use a 1429 period moving averages, use a smoothing period of a 14 or a 12. This is their own strategy. This is their own interpretation. The fact is, you can do whatever you want to do. You can make it what you think is a more reliable signal. But once you make a change to the 12.26.9, you have to then go back and back test it and test it, because the standard interpretation no longer applies once you've changed or customized your setting. You have to come up with your own interpretation and make sure it is correct. But lots of it do this. There's nothing wrong with doing it. But it's just something you need to be aware of. But now we have our MACD on our charts. Now that we have MACD on our charts, we understand what the lines come from. We understand we may get whipsawed in and out. We could get false signals. We understand where we see trend momentum. We understand where we see trends. We understand the zero line cross. We understand a lot. Now, how do we use this to trade? And by the way, I said I was going to mention Bitcoin today because this was my analysis this morning. And I'm amazed. I mean, I never, ever thought that Bitcoin would hit 48. And then it went, everybody's betting it's going to break 50. But can you imagine a $10,000 price move over a couple days? Somebody's talking it up. Well, I don't trade Bitcoin, but I do write the analysis for one of my clients. So just so that you're aware. But it's just an unbelievable price move today. So let's go back to my PowerPoint. Uh-oh. There we go. So the MACD histogram is just an elegant visual representation of the difference between the MACD and its 9-day EMA. The histogram is positive when the MACD is above the 9-day EMA and negative when below. If prices are rising, the histogram grows larger as the speed of the price movement accelerates and contracts as the price movement decelerates. The same principle works in reverse as prices are falling. So you can see the momentum and measure the speed of the asset by looking at the depth of the histogram. So the moving average convergence and divergence indicator is both a momentum oscillator and a price-based oscillator, and is one of the most reliable studies we have. While it is a lagging indicator, it works well in all time frames and with all stocks and futures contracts. It is a highly interpretive probability signal that is based on the difference between 3 moving averages and its histogram. Why 3? The 26 to 12 and the 9 that we use to average down below. Now, a key part that's often overlooked to MACD is the center line and the movement, not necessarily the crossover center line, but when the MACD histogram is moving towards that center line or moving below the center line or moving above the center line. Because a lot of times it'll move towards the center line but never cross. So keeping in mind that center line can help us understand what is doing. So MACD can be helpful for noticing potential trend changes at a very early stage. However, if we wait for the zero line cross, we are essentially trading a moving average crossover, which is inherently lagging the market. So in an effort to more closely follow the relationship of the MACD and the signal lines, traders can follow the histogram, which is simply a bar chart plotted around the zero line. Now, MACD tells three different stories. We can use it in three different ways. It shows us divergences, crossovers, and overbought and oversold conditions. So as I mentioned, the crossovers even happen when the MACD line and the trigger line cross each other, or when the histogram crosses above or below the zero. And as I said, I use simply the histogram. But you can see each time here that the MACD crossed over itself or the histogram crossed above or below zero, we generated buy or sell alerts, transaction signals. Now, there's also divergence. I never use divergence, and I never actually see it till it's too late. Divergence occurs when the MACD line is moving in one direction while the price is moving in the opposite direction. So here we can see that the MACD line was making lower lows from one to the next peak, while the price was making higher highs. So we had divergence. So an indication that an end of a current trend may be near occurs when the MACD diverges from its symbol. Again, I don't ever see divergence. Somebody can point it out to me and I'll see it, but I never see it easily on my charts. So remember, the MACD histogram is an indicator of an indicator. In fact, MACD is also an indicator of an indicator. This means that the MACD histogram is 4 steps removed from the price of the underlying security. So in other words, the first derivative is the 12-period EMA and the 26-period. Remember the two lines we put over price. Then we take the 12-day EMA or the 12-period EMA and subtract the 26-period EMA, and that gives us the MACD line. It's the first line we put below. That's our second derivative. Our third derivative is the MACD trigger or signal line, which is a 9-period moving average of the MACD line that was placed below. And the fourth derivative is the MACD histogram, which is the MACD less its signal line. So this is the base for this indicator is, of course, the price. It takes 4 steps to get from the actual price to the MACD histogram. So we want to talk about massaging data. While not necessarily a bad thing, charters should keep in mind, keep this in mind when analyzing the histogram. It is an indicator of an indicator. So it has become standard to plot a separate moving average alongside the moving average, which was the MACD and the MACD signal line. When they cross over each other, it gives us transaction signals. Or in the histogram case, when the histogram goes above or below zero, it gives us buy or sell transaction signals. And we'll call them transaction signals because they do not tell you how far the move is going to go or whether you can actually get a trade in that will make enough profit or cover your spreads. So keep in mind, it's only like slapping you on the back of the head saying, hey, trader, here's an opportunity. Now do evaluate it. Now, as mentioned earlier, the MACD indicator is calculated by the difference between the short-term moving average and the longer term. Given this construction, the value of the MACD indicator must be equal to 0 each time the two cross each other. So the various signals generated by this indicator are easily interpreted and can be quickly incorporated into any short-term trading strategy. At the most basic level, the MACD indicator is a very useful tool that can help traders ensure that short-term direction is working in their favor. Because as the histogram goes up, we are looking at upward momentum and an uptrend. When histogram is down in red and down, we're looking at a downtrend or a downward movement. So therefore, you know that you're trading in the direction of the trend. You can measure the momentum of that trend and the speed of that trend, as well as get your buy and sell signals. Now, traders should be aware that the whipsaw effect can be severe in both trending and range-bound markets because relatively small movements can cause the indicator to change direction quickly. The large number of false signals can result in the trader taking many losses. When commissions are factored into the equation, the strategy can become very expensive. So like I said, think of them as just alerts telling you, here's an opportunity. Now go do your own analysis, figure out whether you can make that trade, figure out where your target point should be, where your stop loss would have to be, and then do your own. So it's like I said, it's just like somebody hitting you in the back of the head saying, here's an opportunity, go figure out if you can take advantage of it. So the MACD indicator is the most popular tool in technical analysis. The nice thing about it, MACD works great and adjusts itself immediately on a 15-minute chart, a 5-minute chart, a 10-minute chart. You know, a lot of indicators do not give you reliable signals in short-term trading. MACD does. And because it gives traders the ability to quickly and easily identify the short-term trend direction, the clear transaction signals help minimize the subjectivity involving a trend. And the crossovers of the signal line make it easy to ensure that you are trading in the direction of the momentum. Very few indicators in technical analysis have proved to be more reliable than MACD. And this relatively simple indicator can be quickly incorporated in any short-term trading strategy. But remember, momentum in charting is similar to momentum in physics. If you throw a ball in the air, it will ascend at a slower and slower pace the higher it projects. After monitoring the changing momentum, a person can determine when the ball will stop climbing and change direction and descend to Earth. This is very easily seen in the histogram. So just like physics, momentum changes occur before the price of an asset changes. So watching that histogram can help you predict changes in the momentum and speed of a trend and a likely time that the asset is going to reverse. So thank you very much for joining us today. Thank you for supporting Alvexo. And we'll see you in our next class. And I hope you learned a little bit about MACD. Like I said, it is the MACD histogram is the only indicator I use. Okay. And remember, an indicator is simply an interpreter of what price action is trying to say. So if you can't understand price action, you might turn to an indicator. So thank you very much and have a great trading week. And thank you for supporting Alvexo. Bye now.